me today the perfect voice who looks at all these factors which impact the market very closely, apart from choosing good stocks. N Jayakumar, Jakes as we popularly call him, is joining us now on the show. Jakes, good afternoon. Jakes, so what are your thoughts first on the kind of fear which has gripped the street, not only in India but globally, because of this crude thing going out of hand? Nobody had imagined that the conflict would last almost over 10 days now, and it is not. There are no signs that it is getting arrested anytime soon. What are your thoughts on this?
First of all, I think thank you for having me on your channel. Great day to be speaking, actually, because what you talk about fear gripping the streets, all said and done, please understand, a lot of what you see are futures traded prices. A whole host of people had written call options, the oil, crude call options at 110, 120, etc., which are essentially being, they've been sort of caught out, as it were. The reality is that physical crude for 3 months out, 4 months out, is available at $25 to $30 lower, number one. Number two, as one of the financial papers carried a story this morning, that Russia is willing to offer crude at 25% cheaper than current levels to its trading counterparties like India, etc. So I think we must not take away the fact that, yes, there's been a massive dislocation. Can this dislocation remain permanent? Can Russia afford it as much as the rest of the world is experiencing it today? I think there is no easy answer to this. Even if people logically believe that they shouldn't push somebody, and they may well end up doing it, as indeed has been the case with Putin, who thought he could get a 2-day, 3-day win, if you will. It's turned out to be a longer thing. Now, his economy is under tremendous pressure courtesy of the sanctions. So I definitely believe that bilateral arrangements will start off soon, whether Russia, China, the yuan ruble trade, or the rupee ruble trade, for instance, between Russia and India. I mean, if India has considered Russia and vice versa a strong political ally over the last N number of generations, this is the time to sort of step up to the plate, as it were, because what Russia has, and if they can't supply to the rest of the world, they'll be happy supplying it to its trading partners or its politically aligned partners. So the way I see this, yes, the short run looks extremely dislocated and panicky, if you will. But I think the reality is that I have personally turned very, very bullish at these levels. I think if you look at each and every industry right now, other than perhaps the FMCG industry, where a lot of stocks have, the big ones like the levers and the paints, etc., Asian paints, have corrected a third to 40%. And, it seems that they are no longer the sort of safe havens as they were. And a new move in the markets will be heralded with new stocks. And I think that metals, to that extent, yes, there's a dislocation trade, but those companies that are fully integrated, I repeat, fully integrated. So when people talk about steel prices, what's equally important is to figure out which are the companies that are integrated, whether on iron ore or coal for that matter. It's very clear that the use of steel, for instance, has dramatically gone up, maybe even in preference to RCC, etc., in various construction scenarios. From that perspective, and the capex cycle being rolled out in India, I'm extremely bullish on steel and steel stocks, especially those that are integrated. So something which is not even talked about, many of these companies have picked up coal and iron ore mines, iron ore locally and coal outside India, Mozambique, South Africa, etc. And I don't want to talk stocks, but this can be researched, where the integration has never felt better than right now. Because when prices move up because of cost push, all that happens is you're really trying to pass on the cost, demand could get destroyed. But to the extent that you're integrated, any price increase virtually becomes PBT for you, or a large percentage of it. So going back to sectors, for sure, the financial services sector, the entire PSU basket looks extremely good at this point in time. The capex cycle is underway in many of these companies. Many of these companies have become very attractive dividend-paying stocks, and many of them are on the divestment list. That's one side. Metals, PSU banks, these are the kind of stocks that could lead the next leg of the rally. I think FMCG could pause, which means that the upside could be limited. But the other eye on the rupee at 77, even if there was RBI intervention, etc., it is a lot higher than the 71, 72 it's been, say, 6 months ago, which means that pharma and IT could be the other pillars of this next move. I say the next move because I think a lot is discounted in the price and a lot more. High quality index stocks are available at low double-digit PE multiples. And this we've not seen for a very long time. Metal stocks that typically have traded at 6 and 7 EV EBITDA are trading at 2.5 and 3 times. So I'm extremely bullish at these levels. And the fact there's so much fear, the fact there's so much trepidation and large-scale FI exit, in fact, emboldens me to say that the short run may be painful, but just beyond maybe even the next couple of weeks, I think we could see significantly higher levels.
Fair point, Jake's. Short term can be painful, but you like value in select IT, pharma, and PSU banks is an area apart from metals. What are your thoughts on one global issue I'd like to get your opinion, and that is growth, which seem to be getting slowed because of this conflict. IMF said the same over the weekend. China put its growth at lowest level since 91. Germany cut its growth target. If growth actually gets so meaningfully impacted globally, could it also force Fed's hand, and the rate hike cycle could be slower than what the street is pricing in right now? Could that be also some kind of a support for equity as an asset class globally?
Yeah, for sure. So there are two parts to this actually. I think the integrated view of the world that we took a few weeks ago, maybe that's here for a change. I see a lot more bilateral bilateral arrangements happening. And to that extent, I think deglobalization in individual countries is probably the way forward. So those countries or those markets that have a robust domestic economy, again, India comes in, right up there, if you will stand to benefit. And those that have been purely export driven could be impacted. I think here we have a fantastic confluence of factors where the rupees remained largely stable, other than for the recent sort of inching up. Exports have now got a positive catalyst of 3-4% as far as rupee is concerned. But to the extent that global growth may be on the decline, certain markets may not be, as robust for them as they have been. But the domestic economy, courtesy of the government actions, I believe a domestic economy that is strong on the capex cycle will therefore be positively oriented towards either capex stocks or it is metal stocks or any of these infrastructure-oriented plays. And we can't take away the fact that deglobalization, which was set in vogue a few years ago, will still continue. And overlay this with the fact that geopolitically, I think the Russia-China combined, if you will, has been now turned out to be much more than a countervailing force for whether it's NATO or it's the US itself. And from that perspective, I believe that some changes there are important. But to the extent that Russia has been such a large treasure trove of primary products and exports, whether it is wheat, whether it is natural gas, whether it's oil, metals, etc. The fact that we have the kind of relationship we do with them could turn out to be a huge plus in geopolitical and economic interactions over the next several years. Because one thing is very clear, the impact of the sanctions is not going to come away overnight. So we can't wish the sanctions away. Even if there was a de-escalation, I think the sanctions are here to stay because once bitten, twice shy. The West has realized that the way to sort of bring Russia to its knees is through economic sanctions. That's not going to change. And beyond that, I do see, as I said, in this sort of new world order slowly evolving, India being benefited with positive cash flows, positive FII flows and inflows over the next few years, as they have been for the startup economy over the last 2-3 years.
Jakes, the other important element which market will definitely watch out for closely is UP elections. Exit poll will come this evening onward, and of course 10th is when the because it is being seen as a semi-final for the main match in 24. However much you say that it's, the importance has diminished with markets at these levels, it will continues to remain a factor. What is in the price in your view? A majority, of course, but what levels could spook the street, giving that their grip is loosening, and what levels would please the street in your view, if you have that specific number?
I don't, and I think impact-wise, a seriously negative outcome probably is not factored in, but something below the majority mark could be a knee-jerk reaction. But elections, budgets, these last for a few days at best, a day or two now, and to the extent that markets have corrected, I dare say that if there's a positive surprise, this would actually act as a springboard. My personal feeling is a lot is in the price, and ultimately for those who are choosing stocks and not even indices to that extent, my takeaway is that focus on your stocks, get into those. The theme, the underlying trend is clear. Markets ultimately are slaves to earnings, are slaves to cash flows, and markets in terms of valuations are moving decidedly in that favor. And the very fact they have rejected some of the new offerings, the new age stocks, if you will, indicates that IPOs from that space may be limited or few and far between. So if the pressure of the IPOs has diminished dramatically, courtesy market action on new listed, new age stocks, and the, I'm not here to say whether the FI flow outflows have stopped. That's been a huge overhang on the market. And if there is one that actually on a daily basis hammers you on the head as a bull, is the FI outflows. Who is to say that can't change? Ultimately, valuations, if they are in your favor, and clearly we're not at 18,500 anymore, we're at 15,900. So from that perspective, there's a lot more going for the markets today than earlier.
Quick last question on the mid-cap, small-cap end of the market, because you have a keen eye out there as well. Do you see that, because after a big re-rating move last year and year before last, they've corrected 40-50% in certain cases. Do you see case to hunt for bargains in the broader market now?
I think you can hunt for bargains in the Nifty. So if you've got liquidity, large stocks, a kind of a longevity built in because you're almost part of the Nifty or the top 500 stocks, the need to go down the food chain, if you will, is a lot less. And I think in this, extremely uncertain backdrop, etc., perhaps, I'm happier right now hunting in amongst the Nifty stocks or the frontliners, if you will. And the top 500 are offering tremendous value on especially on the sectors that I talked about, not across the board. And therefore, I'm happier with that, with liquidity also being on your side in those stocks. So why do we need to go down the value chain? Why do we need to take on more variables? Is a question that I will ask at this time. And there are times in the market when you move to small and mid caps, maybe this is not the time.
Fair point. That's a very important point coming in. You've been advocate of small and mid cap at certain phases of the market, but right now you're saying value hasn't emerged adequately there. In fact, bargains are emerging in large cap, particularly hinting towards Nifty. Thanks very much for your time, Jakes. Always value your inputs and contribution on the channel.